In Chapter 13, we're going to learn how to account for merchandise inventory. Accounting for inventory accurately is very important because errors in the inventory are going to cause errors in your financial statements. Since we use the beginning and ending inventories to calculate cost of goods sold, and then cost of goods sold is used to calculate gross profit, an error in one of those is going to cause an error on all of our financial statements. We'll have an error on the balance sheet because merchandise inventory will be incorrect. We'll have an error on the income statement because cost of goods sold and gross profit will be incorrect. And then when the income is transferred to the statement of owner's equity, that makes the statement of owner's equity incorrect as well. So now we'll look at how inventory errors affect the income statement. There's a direct relationship between ending inventory and net income. So what that means is if ending inventory is overstated, then net income is going to be overstated as well. If ending inventory is understated, then net income is also going to be understated. To prove that relationship, let's take a look at the cost of goods sold and resulting net income calculation. It says here that ending inventory is stated correctly at $72,000. So here we have ending inventory at $72,000 resulting in net income of $40,000. So suppose that we overstated our ending inventory by $10,000. So instead of $72,000 for ending inventory, we're showing $82,000. So since there's a direct relationship, our net income should be overstated by $10,000 as well. And notice that net income has gone up by $10,000. It was $40,000, now it's $50,000. In this example, our ending inventory is understated by $10,000. So since there's a direct relationship, our net income should also be understated by $10,000. And notice now it is only showing as $30,000 instead of $40,000. Now, the relationship between beginning inventory and net income is indirect. That means you're going to have the opposite effect. If beginning inventory is understated, that means that net income is overstated. If the beginning inventory is overstated, then the net income is understated. So remember, the ending inventory and net income have a direct relationship, and then beginning inventory and net income have an indirect relationship. There are two types of inventory systems used to record inventory that we're going to look at. The first method that we will look at is the periodic inventory system. Now, this is the system that we used back in the last chapter when we recorded our purchases. We were using the periodic system. And under this system, we only have the correct merchandise inventory figure periodically. We go and count it at the end of the year so that we can adjust it to the correct amount. So we don't keep a detailed record of individual inventory items. And when we purchase inventory, we don't debit the merchandise inventory account, we debit purchases. So really, merchandise inventory sits there from the beginning of the year until the end of the year before it's adjusted. So it's only correct one time, and that's at the year end after we make the adjustment, after we've counted it. So merchandise inventory is not an active account. When we purchase inventory, we debit the purchases account. When we sell inventory, we just record the sale. We debit accounts receivable and credit sales. Now, under the perpetual system, this is the system used by larger merchandisers like Walmart and Target. When we purchase inventory, the merchandise inventory account is immediately updated. So merchandise inventory, the account is very active. When we sell inventory, we immediately take the inventory that was sold out of our inventory account. So for example, when Target gets a truckload of merchandise, it is scanned in and the merchandise inventory account is immediately updated. Then when the merchandise is sold, once it is scanned out, the merchandise inventory account is again updated for the sale. So we know exactly how much merchandise inventory we have at any point in time. At the end of the year, we don't have to do an adjusting entry because our inventory should be correct or pretty close to correct. Of course, there are errors and maybe theft and damages that we'll have to account for, but we just do a little adjustment to after we do the physical inventory to make sure that it's correct, but it shouldn't be a large adjustment. Okay, now you will have to know the journal entries under both the periodic and the perpetual system. Now, the ones you need to focus on will be the purchases and the sales transactions. So, for example, when we purchase merchandise under the periodic system, remember merchandise inventory is not active. It's not an active account. So we debit purchases and credit accounts payable. And then when we make a sale, we just record the sale. We debit accounts receivable and credit sales under the periodic system. Under the perpetual system, merchandise inventory is the active account. So when we buy inventory, we're going to increase merchandise inventory and then credit accounts payable. When we sell inventory, we're going to record the sale just like we did before, debit accounts receivable, credit sales, but then we're going to update our merchandise inventory account by our cost because we sold the inventory, so we need to move the inventory out of merchandise inventory with the credit, and then we debit cost of goods sold. Now, under both systems, the periodic and the perpetual, it's important that we take a physical inventory. It's really important under the periodic system because we need to find out the ending inventory. We cannot calculate cost of goods sold and net income if we don't have the ending inventory under the periodic system. For the perpetual system, we're really just taking inventory for comparison purposes. We're going to compare what we have on our accounting records to what we just counted. And there's usually a little adjustment there to make up for maybe errors and omissions. Usually businesses will close down or take inventory after regular business hours, but not always. Now here are some things we need to think about as far as considering what goes into ending inventory. So many times companies will hold goods for sale that are owned by other companies. The owner of the goods is called the consignor, and the company holding the goods is called the consignee. In this case, the value of the inventory is going to go on the consignor's books, not the company holding the goods. Now we need to consider also goods in transit. We studied FOB shipping point and FOB destination in the last chapter. These terms are really important because whoever is paying for the shipping is who the goods belong to during the shipment. For example, if goods are in transit on December 31st at year end, whoever is paying for the shipping is who will include those goods in their merchandise inventory. If they were shipped FOB shipping point, the buyer is paying for the shipping, so the goods, while they are in transit, belong to the buyer and will be included on the buyer's inventory. If they're shipped FOB destination, they don't belong to the buyer until they get to the buyer's destination. So the seller is paying for the shipping, so those goods would be included on the seller's inventory. When we refer to the cost of our inventory, that means all the necessary and reasonable cost to get the goods to the buyer's place of business. So of course that includes the purchase price, the delivery and shipping and freight costs to get it to the buyer, any insurance that was taken out to get the goods to the buyer, or storage fees. There are 4 inventory methods that we're going to look at in this chapter. They're specific identification, first in, first out, weighted average, and last in, first out. So we're going to use these periodic inventory methods to cost out our inventory and also to figure out our figure for ending inventory. We'll look at specific identification first. Companies who can specifically identify their goods. They're separate, so they're able to tell what the cost of each one of those items is. They're able to maintain those records. So for example, car dealers, when they get a truckload of cars in, they know from the invoice exactly how much each automobile cost, and they can identify those separately. Other industries that use the specific identification method may be those who sell furniture, jewelry, or expensive clothing. You can probably think of a lot more. Now let's look at this specific identification example. We have inventory on hand. Remember, every company, unless it's just brand new, they started the year with inventory on hand. So this company had 40 units at $62 each. That was their last year's ending inventory, so that carried over to this year as the beginning inventory. Then they made a series of purchases. They made one purchase of 60 units at $65 each, 80 units at $67, and 70 units at $68. So their total units available for sale was 250. So that term should be familiar, goods available for sale. At the end of the year, they did a physical inventory, and 50 units were found still on hand. So the question is, how much did these 200 units cost that we sold, and how much did these 50 units cost that we still have on hand in ending inventory? Since we're using specific identification, we should know exactly which 50 units these are and how much we paid for each one of them. The problem should give you some specific information so that you can figure that out. In this problem, they are telling us which items were sold. So we know we sold 200, and here are the 200 that were sold. And so if we can figure out the 200 sold, then we can figure out the ones that we still have. Okay, so 30 from the beginning inventory at $62 each were sold. So 30 units at $62 is $18.60. 50 from the first purchase were sold. Okay, so 50 at $65. 60 from the second purchase, those cost 67 each, so 60 at 67. And then the third purchase, we sold 60 at 68. If we add those up, we get our cost of goods sold. Now, so it's easy to take this figure and back into your ending inventory because all the goods we had available for sale was 16,500. If we have sold 13,210, that means that our ending inventory cost $32.90. And notice that the ending inventory plus the cost of goods sold should always add back to the goods available for sale. The next system is the first in, first out method. And this just assumes that your inventory flows from the first in to the first out. That means that the first ones you purchased are the first ones sold, and the last that you purchased would be the last ones sold. So any goods remaining in ending inventory would be made up of the last items that you purchased. Okay, so here is the same scenario we had before, but remember this time we're not using specific identification. These goods cannot be specifically identified. We're just simply assuming that the first goods we purchased are the first ones we sold. So in the problem it's telling us again that we sold 200 and we still have 50. That means the first 200 of these units were the items sold, and then the last 50 is the cost of ending inventory. So when you're working with first in, first out, it's always easier to figure out the ending inventory because it's a fewer number. So if I need to find out the cost of these 50 units, I have to assume under first in, first out that the last 50 that I purchased here is what is left in my ending inventory. So I can cost those out really easily. Down here I have 50 units at $68, so my cost of ending inventory is $3,400. Well, I can easily get my cost of goods sold by subtracting 3,400 from 1,650, and I would get 13,100. Or you can do it the long way, which would take the 200 and assume that these first 200 were sold. So I would take all 40 at 62, all 60 at 65, all 80 at 67, and then 20 of these would bring me up to my 200 count. So 20 at 68 is 1360. If I add all these totals, I get 13,100. And I can check to make sure my math is accurate by adding 13,100 and 3,400 and making sure that I come up with the goods available for sale, which was 16,500. Okay, the next one is last in, first out. It's kind of the opposite from first in, first out. This assumes that you are selling your newest inventory first and leaving your old inventory on the shelf. So depending on the inventory, that might not be the greatest of ideas. So for example, if you sell computers, you want to sell your oldest computers first, or either they're going to sit on your shelf and become obsolete. But remember, these are just cost flow assumptions. It doesn't mean that our inventory actually flows that way. Okay, so last in, first out. So that means that the 200 sold were the last 200 that I purchased, and that the 50 that I have in ending inventory are the first 50 that I purchased. So once again, let's work with the ending inventory because it is the lowest of the two numbers. So under last in, first out, the last ones have been sold, so my first units are the ones that I still have. So I have all 40 of these at $62, and then I'll need 10 from the first purchase at $65 to get up to 50 units. And if I add those figures together, my ending inventory is valued at $31.30. I can easily get my cost of goods sold by subtracting $31.30 from $16.5 to come up with $13,370. And this is probably the approach that you'll want to take on your assignments. Now we could do it the long way. We can calculate the cost of goods sold by taking the last 200 units and assigning cost to those. So I would take all 70 of the last purchase because I know I'm selling my newest ones first. The next, I'd pick up the 80 from the second purchase and cost those out. So at this point, 80 and 70 is 150. So I know I need 50 more from this purchase. So 50 at 65 will give me 3250. I'll add the totals and come up with 13,370. And I want to make sure that my math is good by testing it, taking the cost of goods sold plus the ending inventory to make sure I'm coming up with my total cost. Okay, and then the next system is called weighted average. And with weighted average, we just get an average cost of all our units. So we'll just assign one average cost to each unit. And this usually is used by companies that sell products like in volume, like grain, gasoline, or coal. The weighted average method is pretty easy to apply. You simply take the total cost of the goods available for sale and divide by the number of units available. So when we do that, we just get an average cost. 16.5 divided by 250 gives us an average cost of $66 per unit. So if I need to know how much my cost of goods sold is, I have to multiply 200 times 66. If I want to know what my ending inventory is valued at, I multiply $66 a unit times 50 units. This chart will give you an idea of how goods are costed out under each method. And notice that last in, first out is going to give you the lowest gross profit because it gives you the highest cost of goods sold. And this method is frowned upon by the IRS because, of course, they don't want you to understate your gross profit. Weighted average is somewhere in the middle. And then FIFO, first in, first out, is going to give you your lowest cost of goods sold and highest gross profit. And then specific identification is going to give you really your exact gross profit. The next method we'll look at is lower of cost or market. And this is a way that we value inventory where we go ahead and take a loss if the price of our inventory drops while we're holding it. So if the cost of merchandise that we have on hand in our inventory is higher than the market price, which is the cost to replace an item, we're going to use that lower value. That's why it's called the lower of cost or market. So remember, cost is what we paid for the item. The market price is how much we have to pay to replace it. And we're going to value at our inventory at whichever is lower. So if our cost is higher than what it cost us to replace it, that means the value of our inventory is kind of dropped. We'll go ahead and take a loss. And this is called the accounting concept of conservatism, because we will always take losses that we anticipate, but we'll never anticipate a gain because that wouldn't be very conservative. So here's an example. If our inventory cost $8,000, that's what we had to pay for it. If the market value, the new price of the product is $7,000, that means we've had a drop in price. So we're going to use the lower of these two items in our ending inventory. Okay, under item 2, notice that the market value is $10,000. So we haven't lost any value of our inventory, so we're going to go ahead and leave it at the cost, which is the lower of the two. And then here, once again, the market value of our inventory has fallen. So we are going to value our inventory at the lower. So if we add these three items up, our inventory will be valued at $22,500, even though we actually paid $24,000 for it. The next method is the gross profit method. With this method, we can estimate the cost of our ending inventory because we should know our goods available for sale, and then if we can figure out our cost of goods sold, we can back into our ending inventory figure. The important thing to remember about the gross profit method is the cost of goods sold formula. In the problem, you'll be given just about every number that you're going to need, but you will need to plug those into the cost of goods sold formula. And that's, remember, beginning inventory plus purchases will give you goods available for sale. And if you subtract out your cost of goods sold, you'll be left with your ending inventory. So let's look at the problem. We had net sales of $250,000, and it's telling us that of that $250,000, 35% is our profit. The beginning inventory is $80,000, and the net purchases are $120,000. So we can go ahead and plug in the beginning inventory and the net purchases to give us our goods available for sale. Now we just need to figure out our cost of goods sold. So we have $250,000, 35% of that is profit. That means the other 65% of it is the cost of our goods. So 100 minus 35% is 65%. So 250,000 times 65% is 162,005. Now remember, don't use the 35% because that's our profit. We want the cost. And you could also do 35% of 250,000 and then subtract that figure from 250 to get the 162.5. But it's just easier to go ahead and convert your percentage to the cost percentage by subtracting it from 100 and getting 65% and then apply that to the 250,000. So that means our cost of goods sold is 162.5, which leaves us with an ending inventory of 37.5. We had 200,000 to sell. We sold 162.5, so our ending inventory is 37.5. The next method of estimating your ending inventory is called the retail method. And under this method, we have two sets of figures that are going to be given to us. One set is for the cost, and then the other set is for the selling price of the merchandise. So we are going to calculate the goods available for sale at both cost and retail to figure out a cost percentage that we can apply to our ending inventory at retail. So that one works like this. Once again, we're going to be using our cost of goods sold formula, but we'll be given figures at both cost and retail. So in the problem, the net sales are 100,000, beginning inventory at cost is 30,000, and at retail is 50,000. Net purchases at cost are 75, and at retail 100,000. So the first step is to calculate the goods available for sale at both cost and retail. So I've brought down the beginning inventory at cost and retail, and I've brought down the net purchases at cost and retail, and totaled them up to calculate the goods available for sale. Now I'm going to insert the net sales right underneath the goods available for sale under the retail method. These sales actually represent the cost of goods sold at retail price. So if we subtract the net sales from our goods available for sale at retail, we'll get our estimated ending inventory at retail. The third step is to calculate our cost percentage. To do that, we're going to take our goods available for sale at cost and divide it by the goods available for sale at retail. So the 105 divided by the 150 tells us that our cost is 70% of our retail. So now we can apply this figure to our estimated ending inventory at retail to come up with our estimated ending inventory at cost. So here we've taken our cost percentage, the 70%, and applied it to the retail amount to get 35,000 as our estimated ending inventory at cost. Now we're going to look at recording purchases using the perpetual method. So we're stepping away from the periodic method for a minute, and we're going to look at journalizing inventory purchases and some inventory sales using the perpetual method. And remember, the perpetual method is where the inventory account is active, and we're constantly updating it every time we purchase or sell inventory. So on July 15th, DeBice purchases merchandise on account from McFarland for $800. So to record that purchase, before under the periodic method we would debit purchases, but this time we're debiting merchandise inventory and crediting accounts payable for the $800. On the 21st, DeBice sells merchandise to Harper on account for $1,200. The cost of the merchandise is $800. Okay, so under the perpetual method, we have to do 2 journal entries for a sale. We have to record the sale and then move the inventory out of our merchandise inventory account at cost. So we sold this to Donna Harper for $1,200. That's the retail price. So we're debiting accounts receivable, crediting sales for $1,200. Now it's telling us that the cost of the merchandise was $800. We need to take that out of inventory with a credit and debit cost of goods sold. So we can really look at these 2 journal entries and tell what the gross profit was on the sale. If we charged our customers $1,200 and the inventory cost us $800, then our cost of goods sold, or excuse me, our gross profit would be $400. To record freight under the perpetual system, freight is included in the cost of the inventory. So with the perpetual method, the freight account does not exist. Under the periodic method, we would just simply add the amount of freight, the $190, into the freight in account. But with the perpetual method, it just becomes a part of the inventory. So we're going to add the $1,200 cost of the merchandise plus the $190 shipping, and debit merchandise inventory for the entire amount, and then credit accounts payable for $1,390. To record a return, it says on the 24th, Donna Harper returns her purchase of July 21st for full credit. So this is a sales return. Remember, we sold this merchandise to Donna Harper, and now we're going to have to debit sales returns and allowances and credit accounts receivable at retail. And then we're going to have to move the merchandise inventory back into merchandise inventory, and then credit cost of goods sold for $800.